Kelly, thank you so much. And Mark, thank you for doing this today.
Thank you, Leslie. Great to see you.
Good to see you, too. I want to start with Citi's transformation. We're about 2 years in, and it's been met with a lot of street enthusiasm, as well as some skeptics. You all reiterated in the release your medium-term targets of 10 to 12% ROTCE, return on tangible common equity, within the next few years. But today's report suggests the bank is still about half of those levels. So I'm curious where you see the key drivers to fill that gap.
Yeah, well, I'm glad you asked about the transformation. Jane and I both describe it as our #1 priority. There are two things we're focused on this year. One is the transformation. The other is driving performance across our businesses. And that speaks to the path for these returns of 11 to 12%. If you look at the quarter, we generated $20.1 billion in 4% revenue growth. I highlight that because the 4% revenue growth is the same level of growth that we're forecasting for that medium-term period. So quarter two is another proof point of our ability to do that. Where does that come from? It comes from each of these businesses that we have, these 5 interconnected businesses. So our USPB business had a very strong growth quarter at 6%, good momentum in the cards portfolio. Our investment banking business had growth of 38%, good growth across M&A, DCM, and ECM. Our services business, which we just showcased at Investor Day, had 3% growth and really strong fee revenue growth underneath that. And our wealth business generated 2% revenue growth, starting to see the investment fee revenue in that business. So these 5 businesses are generating strong growth. And markets, of course, generated 6% revenue growth in the quarter, a combination of strong equity markets growth and strong spread products growth. So where does the return accretion come from? Top line performance, continued expense discipline, and we'd expect to see expenses come down to the $51 to $53 billion range in the medium term, and good capital management. And we ended the quarter with a CET1 capital ratio of 13.6%. It's the combination of those levers and executing on this transformation that gets us to those higher returns.
Let's talk about expenses. Obviously, Citi was in the news this week. There was the fine by the Fed and the OCC to the tune of $136 million. It's not just about the cost there. It's also about the scrutiny from the OCC that has some on the street a little concerned. On the call, you said that you take regulators' feedback seriously and intend to use all resources necessary to address them. What does the future look like from here in terms of those resources and in terms of your conversations with regulators?
So first thing, again, in the transformation underlies the consent orders that we got back in 2020. Those were largely around risk management, compliance, controls, and data governance. The orders that we got just a couple of days ago speak to progress we need to make, specifically around data governance regarding regulatory reporting. We've been investing in that area, increasingly so since the beginning of the year. We foreshadowed this was an area we were behind in. We've increased our investment, and we've done that inside of the guidance that I gave for the full year. What's ahead of us? Continued investments here. Investments in people, in technology, and re-looking at the execution and the processes we have in place in order to strengthen the data governance around the entire organization.
Mark, it's Kelly here. Just a quick one. Yeah, Leslie, thank you so much. It's just a macro question, kind of very plain vanilla, but I am curious from where you sit. Do you think you guys are provisioned for an economic slowdown, and do you worry that one is coming with the way the labor market's acting lately?
Yeah, thank you, Kelly. Good to hear you. I do believe we're provisioned well for just about any type of scenario. We have over $22 billion of reserves against our loans that have been booked. That's 2.8% of our funded loan ratio that we've established already. As you know, when we look at the prospect for losses and we run all types of stress scenarios, we look at upside, downside, and base scenarios. We assume unemployment rate in our base, that's about 5%, and we've assumed an unemployment towards the downside scenario of about 6.8%. So we feel very good about our reserve levels. We have seen increases in losses on the consumer side. The corporate losses have been minimal, as we have a very high-quality corporate loan book. And the consumer losses have been the normalization that we were expecting across that portfolio.
Normalization, the credit card losses increased to 3.82%. That was up 17 basis points quarter over quarter. And you mentioned on the media call that delinquencies are bending a bit during the end of 2Q. So can you give us some more color on what you're seeing with regard to the health of the consumer right now? Because I see that tick up, and it looks like, things could be a little bit more concerning, but the picture appears to be a little bit more complex than that.
Yeah, a couple of things worth mentioning. So we have a branded card book, and we have a retail services partner card portfolio. And I highlight that because we're seeing an interesting dichotomy, if you will, depending on the nature of the consumer. So we're seeing spending levels increase on the higher end consumer, the higher FICO score consumer. We're seeing the lower FICO score consumers actually reduce their payment rates and increase the borrowing activity. With that said, you have to think about these portfolios over a multi-year period. And I highlight that because there are multiple vintages that are now maturing, and the losses are normalizing at the same time. Remember, during COVID, we saw abnormally low losses. Those are starting to mature, along with the new acquisitions that we've put on since then. So you have a compounding effect that's playing through the quarter. Importantly, as we look at delinquencies, and pretty much all the delinquency buckets towards the end of the second quarter have shown a cresting, if you will. And so we're watching that very carefully to see how it plays out through the balance of quarter three. And importantly, we're watching the impact of inflation and interest rates on these consumers.
Interesting. Yeah, it kind of feeds into that same narrative about the bifurcation in American consumers.
That's right.
And what we're seeing on delinquencies. Mark Mason, thank you so much for joining us on your earnings day. We really appreciate it.
Thank you, Leslie. Great to see you.
Kelly, I'll send it back to you.
Super.